How's it going, friends and family? My name is Amos, and in this video, I'll be ranking the most popular stocks based on the GARP formula and my personal opinion that I'll just label as the cheese factor. And as you can see on your screen right now, we're going to be analyzing 20 different stocks, and we're going to be placing them into a grade tier ranging from A all the way down to F. With the S tier, I'll get back to you on that one. Essentially, if a company is placed into the A tier, they're the best bang for your buck because the company in question is undervalued and high quality, and I think very highly of them. If we go towards the bottom of the grading scale and the company gets placed into the F tier, well, that means the company is overvalued, it's a bad bargain, or the company is just low quality, and I don't think too highly of it. And it's just not a very good idea overall. But before we go any further, I think I should define what GARP is. So GARP stands for growth at a reasonable price. It's a well-known, much-practiced investment approach. It is a fundamental-driven investment strategy that balances pure growth and pure valuation, as the former tends to invest in high growth, yet expensive stocks, so think like a PE ratio of like 400. High Palantir, while the latter may take a long-term investment to pay off because you're investing into a turnaround story, a rebound story, or a stock that's really beaten up. You fuse the two and you get growth at a reasonable price. You buy into a high-quality compounder at the right price. Now, the GARP Formula intrinsic valuation calculator is something that I spent a ton of time on, and I took a lot of inspiration from the discounted cash flow analysis model, but sometimes the free cash flow, it does not make sense when it comes to assessing, analyzing, and calculating an inherent worth price for a stock, right? Because they might be doing a lot of CapEx, or the industry or sector that they operate in, they don't really generate free cash flow. And that's why I made the GARP formula that's going to be predicated upon future revenue growth. So why is the GARP formula based on revenue growth? Because when it comes to a company reporting their earnings, what I have noticed is that on a high level, they're evaluated on two factors: their earnings per share and their revenue situation. Did you beat on the top and bottom line? Did you exceed your expectations? And what's the guidance that you give for the top and the bottom line? And so through the GARP formula, we can predict and calculate an inherent worth for a company's stock price predicated upon their revenue growth plus their profit margin. As you can see on your screen, I did one for Target. So based on their numbers, fundamentals, and financials, they should be valued at about $116 a share. Right now, they're a little under 99 bucks a share. So the price that I would pay to own Target would be roughly $85.99. So that's the GARP formula, and we're going to be applying that to the 20 various stocks. And the first company that we are going to talk about is Nvidia. They're currently trading for about $180 a share year to date, 35% into the green. Their forward trading multiple is a 26. For a company that's operating at the tip of the spear of the AI movement, a 26. And to be quite frank with you, I think Nvidia is just one of the best pound for pound stocks that's available on the stock market right now. Because unless you have a hidden agenda, I think we can all agree that their GPU chips are best in class. AMD, I hear you fanboys, but it's a clear number two. Nvidia is best in class. And when I think about Nvidia's future, dude, I'm super bullish, because they were going on a massive sell-off in the beginning of this year because of the new administration preventing and not allowing Nvidia to export their chips to China. And China as a whole is a very big customer. However, as of December the 12th, take a look at this. Trump okays the sale of AI chips to China. Whereas on the other hand, the Senate Democrats say this is a terrible idea because it's allowing our enemy to catch up or to even make replicas of our chips. Regardless of who's correct or wrong, in the short term, Nvidia's top line is about to go through the roof. Because not only are they selling their chips to the hyperscalers such as Meta, Amazon, and Google, but now think about all of the Chinese companies like Alibaba, Tencent, Temu, and even DHgate. So when it comes to Nvidia, I think this one is pretty simple. I think they're going to go into, and by the way, the grade letter that's going to be assigned to each company, it's going to be based on two things. Just as a reminder, you can see it right there, their GARP valuation. Are they trading for a good price in relation to their fair price? And then number two is the cheese factor. Do I feel bullish about their future? Do they have a competitive advantage, an economic moat, and what are their upcoming growth catalysts? And by the way, I'm going to keep it real. If a company is ass, I'm going to say that it's a bag of ass. And to be fully transparent, I do not own Nvidia in my portfolio, but when you think about their future, I honestly think they belong in the A tier. This is as good as it gets. Their numbers and financials are absolutely fantastic and phenomenal. And as of right now, they trade for $180 a share. By the time you watch this video, they could be $181 according to the after hours, or they could be as low as $175. But based on the GARP formula, the cheese value per share is $263. So they're way below that. So I think they're undervalued right now. I know you might look at their PE ratio based on the trailing 12-month EPS and say 44 is too high. But friends and family, if you take a look at the growth of their revenue of 65% year over year, I think it's kind of justified. Besides, when it comes to a growth company, I'm looking at the forward trading multiple. So at 26, I think that's really low. I'm bullish about their future. Their valuation looks great. So we're going to kick things off by putting Nvidia into the A tier. And on a side note, if you're curious about my personal buy price, I'm going to go ahead and put that information onto the Patreon alongside the forecast model itself. So that way you can plug and chug any company that you want to. The next company that we are going to talk about is Tesla. Ticker symbol TSLA. Currently trading for about $481. Year to date, they're in the green by 19%. Crazy to believe we only have about 1 week left until it's 2026. Their trading multiple, 315. It doesn't get any better when you look at the forward trading multiple. It's 239. This is a company that is trading for a pretty premium. They're priced for perfection. If there's any setback, headwind, or uncertainty coming their way, they're going to go on a massive sell-off. And I think Tesla, out of the Mag 7, I think they do tend to be a little more volatile, especially among their peers. 19% into the green. Now, at its core, Tesla is running an operation of manufacturing and selling EV cars and solar panels. Ultimately, I don't really feel bullish about their business model because there's so much capex involved with the factories, the manufacturing, and also with the tariff wars that seem to be happening on and off. At least for the next 3 years, we're going to be continuing to see that. They're kind of at the mercy of what their Chinese suppliers are willing to sell their parts for. However, as of November the 15th, check out this article from the Wall Street Journal. Tesla wants its American cars to be built without any Chinese parts, because they want to keep it all in-house so that there's no more dealing with supply chain constraints or tariff issues, or if there's any backlash because of the geopolitical tensions between the US and China. I think in the short term, this is absolutely going to hurt their bottom line, but I think in the long term, I cannot help but agree with Elon Musk. I think that's the right plan. However, what we have to keep in mind is that a GARP investor, dude, they don't pay 239 times their earnings for a company where their revenue is decreasing, negative 1.5% year over year. It doesn't make any sense to me why you would pay 239 times their earnings. What do I mean by that? If you take their share price of $481 and you divide it by next year's earnings per share, that'll equate to 239 as their PE ratio. If you only consider the trailing 12 months, then you're going to take this 481 divided by $1.45 of profits per share. If the revenue is declining 1.5% and the PE ratio is 315, it doesn't make sense to me. So their short-term performance in the stock market, it doesn't make sense to me. As a matter of fact, I think they're absolutely overvalued. So when it comes to Tesla, now I don't want to sound like a Debbie Downer, because if given the option of driving a Tesla, I would absolutely drive one of their cars. I don't own one. I actually ride a bicycle to get around town here in Japan. But if I had the opportunity to operate and drive a Tesla, I would. But sometimes we have to separate the business or the product or service itself from the stock price. And as a publicly traded company, I'm not really feeling their valuation. I think if their trading multiple was closer to something like a 30 or a 25, I think that's more palatable and digestible, but to see a 300, but their top line is decreasing 1.5%, I mean, according to the GARP formula, their inherent worth is $345 a share. And right now they're $481. So no matter how I look at it, spin it, or manipulate it, they're just way too overvalued. So when it comes to Tesla, I do think they have nice cars, but in terms of their stock price, would I want to buy into it right now? Absolutely not. I don't think it's a good deal. I think putting them into the F tier is a little harsh. So I'll put them right here into the D tier. And on a side note, Tesla really reminds me of Aeon. They're an HVAC player that's trying to keep everything in-house, manufacturing and producing HVAC equipment. So they're doing the same playbook as Tesla. And if you take a look at their trading multiple, it's a 62 and the forward trading multiple is a 38. And if we hop on over to their financials, you can see that they're actually positive in terms of their gross sales. So with Tesla, their valuation, it doesn't make sense. And the next stock that we are going to analyze and grade is going to be Amazon. Ticker symbol AMZN. It's a conglomerate that does almost everything at this point, ranging from taking care of your pharmacy needs to hosting a good chunk of the internet because of their AWS cloud platform. Now, they're currently $227 a share year to date, 3% into the green. I'm going to be completely honest with you. For a Mag 7, Magnificent 7 stock, I think that's unacceptable. But it's because they're facing a lot of regulatory hurdles and antitrust probing and monopolistic stuff that they're getting slapped on the wrist for. They're getting the same treatment that Google got in 2024 and most of 2025. But when it comes to Amazon, their performance as a business operation, it's disassociated with their stock price, because you would think for a stock that's only up by 3.6% into the green, their numbers would be hideous, right? Their overall gross sales went up by 11.5% year over year, and look at the amplification of their top line over the years. Just absolutely phenomenal. And if we break it down to their various business segments, every single category is growing up and to the right. When you think about their e-commerce platform, it generated $261 billion of revenue, AWS $121 billion. The one that I'm most bullish about is their advertising growth, 20.5% year over year. So whenever you see sponsored posts or listings, whenever you're trying to shop for something on Amazon, that's Amazon advertising working. So if you want to sell your product and you want it to show up first in the search results, you're gonna have to pay Amazon. So now they're monetizing their e-commerce platform, and they're slowly but surely competing for the open internet ad space. And they're undercutting the trade desk in order to win more advertising campaigns and marketing budgets. So time will tell whether or not their advertising arm will be fruitful. But based on what I see, friends and family, I think this is just absolutely crazy. To post $64 billion of revenue is really freaking impressive. And when you take a look at their most recent earnings, they posted $180 billion of gross sales in only 90 days. And year over year, 13.4% growth. That is just absolutely phenomenal. So when it comes to Amazon, I think I'm really bullish about their advertising arm of the business. But another factor that makes me feel really optimistic about their future is the fact that they operate and they own Whole Foods, the natural and organic grocery chain. And I say that because as of right now, the grocery store stocks like Hormel, Conagra, General Mills, dude, they're getting absolutely hammered. And that's because as consumers, we're gravitating away from high preservatives and eating foods that have like 500 ingredients. And instead we want stuff that's fresh, local, organic, and natural. Whole Foods, they've been ahead of the curve and ahead of the game for a hot minute now. And the fact that it's owned by Amazon, I absolutely feel bullish. I'm jacked to the tits when I think about their organic grocery chain. Another one that's kind of similar to Whole Foods is Sprouts Farmers Market. It's pretty much the exact same thing, but the footprint and scale and the amount of SKUs that they sell, it's like a third of a Whole Foods. And based on this article published by the Food Republic, Sprouts versus Whole Foods, which grocery chain gives you a bigger bang for your buck? They basically compare Whole Foods and Sprouts based on the prices for the different and various aisles, right? The wellness products, bakery and dairy, organic and conventionally grown produce like vegetables and fruit. And in the end, their conclusion and verdict, the winner is Whole Foods. It's just better all around. So even though Sprouts might have a value add with some of their private label stuff, Whole Foods is still the better value proposition, at least according to benchmarking the price of eggs here versus there, or the price of skin lotion here or there. And from my understanding of human psychology, people tend to prefer going to the chain that offers the exact same thing at a lower price. And fun fact, most of the general population, they don't even know that Whole Foods is associated with Amazon. So even if you're anti-capitalist and you hate major corporations, you might find yourself eating at Whole Foods. And I think that's ironic, but also kind of funny. So when it comes to Amazon, the GARP formula spit out a valuation of $273 a share. And as of right now, friends and family, they're way below that. And when I think about their future, dude, I didn't even talk about or address the automation or robotics that's happening in their e-commerce fulfillment centers. Nor did I talk about AWS or all of the other moonshot projects that Amazon's got going on. And by the way, I made a deep dive video talking about Amazon not too long ago. You should go ahead and watch that video. Obviously, I'm very bullish about them, and yes, they are in my portfolio. So when I think about the cheese factor, they absolutely have an economic moat to the point where they destroyed hundreds of different retail chains. They're out of business. They're defunct because of Amazon. So when you think about it on the retail side of the house, bullish. When you think about it on the cloud side of the house, their market share, I think they're still the leader, but it's eroding slowly because Google is taking away some of it. Azure is taking away some of it, but also now we have Oracle, and there's so many different people launching their own cloud endeavors, but still, Amazon prints cash. When it comes to placing them into a gray tier, hear me out. I think their business operations, circling back to how I introduced them as a company, is absolutely fantastic, phenomenal. Even as an Asian parent, I would be so proud. But the stock price, it doesn't follow suit. Because in the past 1 year, 3% into the green. Past 5 years, during one of the biggest bull market runs in stock market history, only 42%. In contrast, if we take a look at Nvidia, past 5 years, 1,200% into the green, right? So even though I'm invested into Amazon because of that, I know this might be controversial and an unpopular opinion, but I think Amazon's going to have to hang out in the B tier. Even though right now I think they're undervalued and a good bang for your buck, the stock price, it's not moving until they win some of the lawsuits that they're hurdling right now. Until when? What's it going to take for Amazon to be compounding 20, 30% a year? Not over 5 years, but per year. Despite that, I'm currently dollar cost averaging into Amazon. I think it's a fantastic opportunity, but in comparison to Nvidia and Tesla, B. I think that's fair. Would you agree? And the next popular stock we're going to be covering is Microsoft. Now, I have very positive feelings about this company because about 9-10 months ago, I made video after video talking about Microsoft and how I believed they were undervalued. So I put my money where my mouth was and I invested heavily into this company and I sold out of them for a good profit. And even though I'm no longer a shareholder, I still think this is a really solid company. But what you have to keep in mind is when it comes to Microsoft, For the longest time in the 2010s, ranging from the recovery of the Great Recession, or actually, let's back it up a little bit, 2007, they were roughly, $35 a share. You fast forward 1 year, 2 year, 3 years, they were pretty much flat for the longest time. And then even when they did grow in their share price, they didn't really see that boom until the pandemic. During the pandemic, I saw their share price go from $100 to $500 a share. So they 4x'd in the span of like 3.5 to 4 years, whereas in the 2010s, this was a loser, boring stock that nobody wanted to touch. And that's because they made the crucial and essential pivot into the cloud, right? The Azure. So this article from the Wall Street Journal, inside Microsoft's new AI super factory, I think this one is based in somewhere in Atlanta or something like that, right? Yes, so the one that you see on your screen right now, it's a data center that's gonna be supporting their AI platform, but also Azure cloud. And as mentioned in their earnings, they're spending a lot of CapEx right now, expanding their footprint of data centers. In the next 2 years, they're going to be doubling their data center capacity, which means their bandwidth for hosting more stuff on their cloud is about to get doubled. And so in a perfect world, their revenue should also double. Because if you can host more customers, because right now you might be bottlenecking them at like 10,000 terabytes, but once you have more capacity and bandwidth, you might be able to charge them more because they actually want 50,000 terabytes. Right? For instance. But me personally, when it comes to Microsoft, I think everyone's really bullish about their Office suite or the Azure cloud. But what I really like about them is that they acquired a very niche online gaming company known as Blizzard Activision not too long ago. So not only do they have Xbox, but now they also have Blizzard. And a part of the Blizzard portfolio is a franchise known as Diablo. I'm not gonna lie to you, dude, as a kid in the 90s, I used to play Diablo on my tiny little Macintosh computer, and can you believe now we're at Diablo 4? And look at the amount of players that are logging in and playing on Diablo 4. 771,000 monthly players. That's a lot. And every single day, 153,000 players. And a fun fact about Blizzard is that it's also the parent company of Overwatch and StarCraft and World of Warcraft. I'm pretty bullish. I really like every business segment and offering from Microsoft. So when I think about their future, dare I even say they should be in the A tier, because according to the GARP formula, their intrinsic valuation right now is $580 a share. And not too long ago, they did flirt with about $555 a share as outlined right there. And since then, they've just been on a tiny little sell-off. So they're currently $485, but their true worth as a company is $580. They're almost undervalued by $100. So good value, promising future, economic moats as wide as your ex-wife's waist. There's a lot to like about this company. I'm going to put them in the A tier alongside with Nvidia. I think of the Mag 7, these two right here make a ton of sense. And I think an argument can be made for Amazon. But for Tesla, dude, the stock price defies the odds and it goes up to the moon, not predicated upon fundamentals and financials. So the Tesla one, I just don't get it. And the next business we are covering is Hims and Hers Health. I just uploaded a thorough deep dive onto the channel, and I promise you it is worth the watch. But as of right now, the $35 a share year to date, 47% into the green. Amazon, please take some notes. And what's interesting about Hims and Hers Health is that not too long ago, they used to be $72 a share. I think probably in February of 2025 or any one of these peaks, right? And unfortunately for them, they're in one of their valleys right now. And their growth of their gross sales is just, it's absolutely diabolical. $26 million in 2018 to $2.2 billion in the past 12 months. There's a lot to like about this company, but with that said, when it comes to their valuation, the PE ratio is a 66, their forward trading multiple is a 60. The whole idea of GARP is buying a really high quality company at a reasonable price. At $35, their PE is still a 60. If they were $35 a share and their PE was, I don't know, like a 28 or a 29, I would feel a lot more comfortable, because then I know that I'm not overpaying for them. So when it comes to placing Hims and Hers Health into a grade tier, it's kind of difficult because I do think their future is really bright, but they do not have any economic moat. But on the flip side of that, according to the GARP formula, and by the way, I'm going to give you a freebie into my personal buy price. The GARP formula says that Hims and Hers Health, they should be $58 a share. Right now, they're nowhere near that number. They're not even $40. So they're absolutely undervalued. And my personal buy price for them is $20 a share. I would not pay a single penny more to buy into this business. But would I want to be a shareholder, a part owner of this company in operation? I think so. This is a startup that's disrupting the health insurance and pharmaceutical space. Two birds in one stone. There's a lot to like about them. But the lack of an economic moat, it holds me back. So even though their PE seems to be high, I still think they're undervalued. As cheesy as it might sound, their PE ratio is a 66, but the growth rate of their revenue year over year is 78%. And so if Hims and Hers Health, they can stay consistent in pulling off and executing 60 or even 70% growth in their revenue year over year, buying them when their PE ratio is a 66, I don't think it's a terrible idea, because when you look at their own DNA and timeline, their growth rate in the revenue, 200%, 80%, 82%, 93%, 65%, 69%, and it's only improving. However, the catalyst that they had helping them, the wind in the back of their sails, it just got disrupted and it's eliminated. So I think with this one, only time will tell whether or not their revenue is going to be growing at an exponentially faster rate for next year, or if it's going to drop off. Break it down on a quarterly basis. It's dropping from 110% to 70% to 50% because that catalyst is no longer there. So if you're curious and you want to learn more about this company, do check out the deep dive that I just uploaded about them. I promise you it is worth your time. And by the way, I'm doing this video not only because it's good content. I would personally watch this video myself in order to figure out and evaluate companies that should deserve a spot in my portfolio, right? So with Hims and Hers Health, I think they would be in the B tier, right next to Amazon, for different reasons. I think they absolutely do have some headwinds in the short term, but in the long run, if the leadership team can continue executing and pulling off their vision, $6.5 billion by the year 2030, I don't want to go on record saying for sure, but kind of sounds like they're going to be a compounder because their stock price should follow suit with their financial performance. Or they could be like Amazon, where even though they're crushing it across all metrics, their stock price is like, what, 3% into the green in 350 days? So I guess only time will tell. Literally, only time will tell. And the next company that we are going to cover is Uber. But before we take a look at their PE ratio, I mean, can we just take a moment to admire the growth in their top line over the years? In 2016, $3.8 billion. And in the trailing 12 months, we're talking about $49.6 billion. A ride-share app. I think that's really impressive. But with that said, it is worth noting that when you take a look at their bottom line per share, this is a company that was pretty much unprofitable up until the year 2023. But ever since they became a profitable business, the increase in their profitability has just been simply remarkable. A 400% increase year over year from 2023 to 2024. And in the trailing 12 months, it improved by 286%. And I think going forward, it's only going to get better. Because Uber right now, they're partnering with Nvidia in order to become one of the biggest robo-taxi networks. Which means as of right now, they're utilizing human capital and issuing them 1099s because they're not officially employees of the business, but rather they're contractors. They're going from that modality to utilizing AI to do all of the heavy lifting and driving. And when that happens, I think their profitability is just going to get amplified and get even better. So when it comes to Uber, Their GARP formula tells me that the inherent worth of their stock price should be roughly $100 a share. And right now, at the time of filming, $79 a share year to date, 31% into the green. And based on a technical analysis, they do seem to be on a downward pattern, which means by the time you watch this video, they could easily be $70 or even $65 a share. So they're undervalued. Their future looks kind of bright, but I would argue they do not have an economic moat, because they have fierce competition from Lyft. Tesla is launching their own robo-taxi service, and in various regions of the world, Uber is not even allowed to operate. Then again, with the numbers that they're executing, to see a PE ratio of a 10 and their forward trading multiple being a 23, I think they're really undervalued. As a matter of fact, after filming this video, I'm going to do a lot more research and homework to see whether or not the market has it wrong when it comes to Uber. But for the time being, I think Uber is going to go into the B tier. I think there's a lot of potential with this one. It's just the lack of an economic moat. That's what's holding them back. And the next company that we are going to cover is Texas Roadhouse. It's a restaurant chain where for about $11 or $12 a plate, and if you buy a drink, I guess $15 per person, you can have a pretty good lunch or dinner. I'm talking about like hamburger, steak, fries, and mac and cheese. It's a pretty good place to eat out. Right now, $175 a share. Their trading multiple is a 26.8. And during their highs, they were roughly $200 a share, just shy of, right? $199.80. And I would even go as far as to say that they're best in class when it comes to eating out and paying a tip. And as a matter of fact, that claim is verified and is supported by the Data Central 2025 awards. If you scroll on down right here, America's best restaurant experience is Texas Roadhouse. And I think these ones all make sense to me. America's most craved chain is In-N-Out. America's favorite chain is Chick-fil-A. And then America's most unique restaurant menu is Crumble. Dude, those cookies, they'll set you back like 600 or 800 calories for just one. America's best to-go chain, Wingstop. America's value leader, Little Caesars. So I live in Japan, and it's been a hot minute since I've been back in the United States. How much is a hot and ready pizza from Little Caesars? Because back when I used to eat at Little Caesars, it used to be $5. Is it still $5? Please let me know. And what else do we have here? America's best coffee chain is Dutch Bros. It's no longer Starbucks. Riddle me that. And America's best healthy chain, that one is kind of surprising. I thought Chipotle would be there, but it does seem like Cava has all of the rage and hype right now. America's best burger chain, hey, this one is controversial, because I would argue Whataburger, the chain based out of Texas, they belong in that conversation. I feel like they taste better, but I think Shake Shack, it makes sense as well if you're willing to pay like $12 for a burger, fries, and a drink. But anyways, all that to say, the GARP formula tells us that Texas Roadhouse should be valued at $191, and right now they're a little below that. I don't think it's the greatest deal or bargain on the market, and I say that as a shareholder of Texas Roadhouse. I still think it's very high quality, and I have no plans on selling out of them. I love their future. I love the fact that they provide the best restaurant experience in the US, as surveyed by that market research website. So with Texas Roadhouse, I would put them into the B tier. I think out of the restaurant chain stocks, I think Texas Roadhouse is probably the best. I think in the second tier would be like Darden Restaurants or Brinker International, the parent company of Chili's. Those are also very good. And Cheesecake Factory, not as bad. But Texas Roadhouse, when you take a look at their financials and fundamentals, best in class, especially in the sit-down restaurant category. And the next one, friends and family, is going to be Costco Wholesale. So they're actually based in Washington State. And so that's why we're reading an article from Spokane, Washington, which is located on the eastern side of Washington. So they actually raised and increased the prices of their membership fees, but the membership renewal rate remains really high. In the US, it's 92%. And internationally, 90%. I think that speaks volumes to how satisfied a customer is. Because if you really hate Costco and you think their service and products and offerings as booty hole, would you want to renew your membership? Probably not, right? I think that's really impressive. But I think that's where my praise for the warehouse chain ends. Because when you take a look at their financials just really quickly, right? Their revenue, it's growing by, what would you say? A single digit number year over year, right? 5% over here, 8% over here, 8% over there. Taking that into consideration, what do you think is a fair price and evaluation for Costco? Do you think their PE should be, I don't know, a 20, 25, or 30? Riddle me this. Tell me why their trading multiple is a 45. Your revenue is growing at a rate of 8% year over year, but you're trading for such a premium that it doesn't make any sense to me. To see it growing at like 8%, it just tells me that this company is overvalued beyond belief, in my opinion. Based on the GARP formula, Costco's stock price should be around $632 a share. So what I'm trying to say is, if you bought into Costco a year ago, 5 years ago, or even 20 years ago, when they were like $20 a share, $100 a share, I think it's a buy and hold. But to think about buying into them at $850 a share right now when their fair price is about $630, $650, is it the wisest choice that we can make? I don't know. So when it comes to Costco, I love the brand. I love what they stand for. I like that they fairly compensate their employees. UPS does as well. But what I don't like is that they're really overvalued. I think they have a beautiful economic moat, because when you compare them to other wholesale warehouse chains like BJ's, dude, it's like David versus Goliath. But Sam's Club, I think their reputation is getting better. But Costco and the brand and what they stand for, if you want, pause this video and open up a new tab and look up a Costco opening in China. Look at the lines to get into a new Costco whenever it opens up in China. The hype and reputation that Costco carries, not only here in the US, but also overseas, people think of Costco as high quality. So their financials, fundamentals, and the business itself is really high quality, but they're just overvalued. And they're not even overvalued by a little bit. I think they're overvalued by too much. So I know this is controversial, but I think I'm going to have to put Costco into the C tier. But hear me out. I think if Costco's trading multiple was closer to like a 30 or a 28 or 25, they would be in the B tier. Easily, right next to Texas Roadhouse. But the fact that they have a 45 PE ratio while executing revenue growth of 8%, I think it's easy for me to put them into the C tier. And the next company is Apple, the maker of the iPads, iPhones, MacBooks. Current trading multiple is a 36. Forward trading multiple is a 33. Year to date, 9% into the green for a Mag 7 stock. I think that's not good enough. But hey, it's 3 times better than Amazon, so we'll give it to them. I think when it comes to Apple, there's various reasons as to why investors feel bullish about them, right? If we break it down to their different business segments, some people really like that they're best in class when it comes to computers. They really are. And M4 Mac is a lot better than my PC that cost $2,000 that I bought 4.5 years ago. By the way, it's on its last leg. It's one of the first major purchases that I'm going to do once I can pocket more funds from YouTube, because right now I generate like $200, sometimes $500 a month. The M series chips are so much better than AMD and Intel as a CPU. It's just so freaking good. But when it comes to the iPhone, I think we can all agree that you could probably get better specs out of a Samsung or a Google Pixel, but I think the reputation and brand of having an iPhone in your hand, especially in places like South Korea or the US or Brazil or Europe, it gives you that social class recognition, right? It's like, I have an iPhone. I don't have an Android. And other people are excited by Apple's endeavors with their tablets, the iPad. Me personally, What I feel the most bullish about is that Apple holds the exclusive global streaming rights for every Major League Soccer match, MLS. So in the United States, in the pyramid of soccer, the first tier is MLS. So that's where stars like Lionel Messi, Son Heung-min, and Thomas Mueller play. And the reason why I'm so bullish about Apple's partnership with the MLS is, take a look at this article, okay? The North American League saw a 29% increase in weekly live viewership year over year. What I'm trying to say to you is, I think in the past, baseball used to be the most popular sport in the United States, and then American football became the king. Soccer was always an afterthought. Nobody really liked soccer up until the 90s. And I think that's when the Americans started to click and we started to get crazy about soccer. And I know this is going to sound controversial, but I think in the next 10 years, I think soccer is going to be the most popular sport in the US. I think American football will be second place, and then basketball will be third place. And because soccer and the MLS is gaining more traction and popularity amongst the population, that means more and more people are gonna pay for Apple TV. That way, they can watch Lionel Messi play live. So that's why I feel bullish about Apple. And when we think about the cheese factor, I think their economic moat is super vast. There's only two paths you can take when it comes to a phone. You can get an Android, made by Huawei, Xiaomi, Samsung, Google, or you get an iPhone. And then when you think about the Apple App Store and the service fees that they charge the developers and everything else, it's a toll booth company. And especially with Apple Pay and them venturing into the finance side of the house, I think everything that Apple is doing is really exciting. The GARP formula says that they should be valued at $268 a share. As of right now, they're $273. So that would put them into that overvalued tier. Not to the degree of Tesla, of being overvalued by like $200, but they are overvalued. Having said that, I still think their products, high quality, I love their future, but because they're not a good value right now, they're fairly valued, I really wish I could put them into like right here, right? C+, B-, but that wouldn't really look clean. So for the purposes of this video, I'm going to anger some people, even though I feel bullish about them. I'm going to put them right here into the C tier. Now, if Apple was $165, $180 a share, or anything under $200, easily into the B tier. Easily. But their current valuation, I can't justify. We have to play by the rules of the game. And it's predicated upon two factors, right? Number one is the GARP valuation. Is the stock trading for a bargain price? And then number two is the cheese factor. The cheese factor, they nail right out of the park, right? It's a Shohei Ohtani home run. But the GARP valuation, C+, B-. And company number 10 is going to be Oracle Corporation, currently trading for about $191 a share. I just uploaded a very thorough deep dive onto the channel. If you want more information about them, you have to go watch it. It's probably pound for pound the best analysis on Oracle on YouTube. You can read the comments and see for yourself, okay? Their current trading multiple is a 36. Forward trading multiple is a 26. And when it comes to the GARP formula, it says that Oracle should be valued at $378 a share, especially considering their backlog is $500 billion of potential revenue that hasn't been realized yet. So they're undervalued by quite a lot. $378, they're currently $190. Sometimes they're like $170, $180. No matter how you look at it, this company is massively and severely undervalued. So when I think about their future, I love it. When I think about their economic moat, I think it's really sticky. The database and the software that they operate, and plus they're venturing into the cloud. What I don't like, I know this is not a part of the criteria or metrics. What I don't like is their balance sheet is just straight doo-doo. Their debt situation is really concerning. Their free cash flow negative. And out of that $500 billion of revenue on their backlog, 300 of that is from OpenAI. Are you telling me right now that OpenAI has a $300 billion to pay Oracle? I highly doubt it. So if this video included a third metric criteria of their balance sheet health, then Oracle would obviously be here in the C tier. But because it's only based on whether or not they're undervalued, predicated upon their future revenue growth and the cheese factor, I think Oracle's going to be in the B tier. This is super controversial, and I understand. But understanding the company and their business and their future, I think it's so undervalued. You got to watch the deep dive that I made to understand why I feel the way that I do. Now, if you want to run your favorite stock through the GARP Formula calculator, please join the Patreon and you will find the spreadsheet there. And by the way, I'm going to take a quick break. This is the end of part 1, episode 1. I'll catch you next time for part 2, episode 2. We'll look at 10 more popular stocks.